All right, welcome to, this is monetary economics. Right? This is monetary economics that we are dealing with today. And today we are particularly looking at chapter 1 and chapter number 2. But I think as a norm, like I promised, we are going to start off maybe with a few questions, just discussing a few questions from the question paper so that we familiarize ourselves with what's going on with our exam as we go on. So I think maybe for today, we'll shy away from these long essay questions and maybe just do the brief questions, and then next time we'll be doing one question with every section, or sorry, with every session, right? So as you can see, the paper that you are going to be doing is basically 2 hours and it's a total of 100 marks. So I think, and I believe they still give 30 minutes for uploading. So 2 hours is fair. It's not really bad. There's enough time to basically cover, I think, 5 questions, if I remember too well. But whatever the case is, I think there's just enough time within those 2 hours to get through the paper. But today, I think we'll go through these type of questions, right? These type of questions, just to give you a brief feel. If you're doing this module for the first time, it's relatively easy, but we'll start off with what is easier, right? With what is easier. These type of questions. So you will get, again, these type of questions in almost every paper that you're going to write. As long as it's ECS 3701, you are most likely to get this kind of papers. So if it's not, sorry, this kind of question. So if it's not this kind of question, it might be a true or false thing. So it's 10 marks, usually a giveaway, right? So we expect that you totalize on this one. So which of the following is correct regarding the effect of the contractionary monetary policy on price level using the exchange rate transmission mechanism? All right, so there's just a lot of fancy words here that have been used, right? A lot of fancy words here that have been used, but I think we all know what a contractionary monetary policy is, right? So that's the main point here. The main point is the contractionary monetary policy, and we are saying what's the effect of this contractionary monetary policy on the price level. Basically, that's what we are looking at, using the exchange rate transmission mechanism. So there are different transmission mechanisms that that can be used, but but we will get through those in time. All right, so what do we expect to happen? So one, we are going to be discussing what happens to the repo rate, right? And then what happens to all other interest rates, and then what about the inflow of capital, what about the prices of domestic stocks and securities, and then what's going to happen to the rand, and then foreign goods, what's going to happen to foreign goods, and then what's going to happen to exports, equity prices, and then aggregate output, and then the cost of imported goods and the price level, right? And that's what we want to see. All right, so at the end of the day, just to break this down, just to simplify this for us. So the contractionary monetary policy at the end of the day deals with, here in South Africa, deals with the repo rate, right? It basically deals with the repo rate. So if it's contractionary, the repo rate is obviously going to be going up, and then if it's going to be expansionary, the repo rate is going to be going down, right? But at the end of the day, what effect does that have on the exchange rate? So this is what we are discussing here, basically, what effects this is going to have on the exchange rate, and then how that's going to be carried over to the other parts of the economy. And that's what we are dealing with. So just basic stuff. This is just basic stuff, simply using fancy words to explain what's going on there. So I already did one for us now. So we expect that the repo rate is going to decrease, right? the repo rate is going to decrease. I think on the notes there, we talk about something that's got to do with the repo rate. So we'll really tackle this again. So because this is monetary economics, we will be dealing with these rates over and over again. So we expect this to come over. But this is a carryover again from second level economics side. You remember when we were talking about how the repo rate affects all other interest rates in the economy, right? So which means if the repo rate is going to decrease, we expect that all other interest rates are going to decrease, right? So if you didn't know what this exchange rate transmission mechanism is, you could at least answer 1 and 2, right? Logically speaking, you already know that, okay, if it's a contractionary monetary policy, the repo rate is expected to, oh, so did I say decrease? Sorry, it's supposed to increase, right? I think I said this one first. It's supposed to increase, right? But what's the logic behind that in any case? If the repo rate is increasing, right? Generally speaking, the cost of credit is high. So the whole point of a contractionary monetary policy is to remove money out of the economy, right? It's basically to drain out excess money out of the economy. So which means the best way in which you can do that is through a contractionary monetary policy, of which, again, I must repeat, you have to increase the interest rate, right? So which is the repo rate there. So once it increases, once you are increasing the repo rate, then all other interest rates in the market are supposed to increase as well. So these ones have got a positive relationship. They always move in the same direction. So I think we are pretty much familiar with this because we've seen this over and over again. Over the past year, I believe the repo rate has been going up, right? They expected it to increase not so long ago, but they didn't increase it. But it has been going up, and the effect of that has been all other interest rates have been going up in the market, right? Now, we want to talk about the effect of capital flow in the market. Now that we are dealing with the exchange rate transmission mechanism, then we are saying, what effect do interest rates have on the exchange rates? That's what we are looking at now. Because primarily, a contractionary monetary policy is first going to affect the repo rate, and then so by increasing the repo rate, and then all other interest rates are going to move in that same direction. But what effect is this going to have on the on capital flow? All right, so the logic now, what you must bear in mind when you are looking at the exchange rate transmission or the relationship between interest rates and the exchange rate is, if let's say our interest rates are going up, like in this case of a contractionary monetary policy, the interest rates are going up. It basically means, take for example, because we are saying all other interest rates are going to move in the same direction, right? So it follows therefore that if you are going to be putting in an investment in a country where there is a contractionary monetary policy, then the interest rate is going to be high. So it follows therefore that you say you are buying bonds in that country, you have invested in the bond market, you expect that the interest is going to be high in that bond market. So if that's the case, this is therefore going to attract capital inflow because a lot of people are going to want to invest where the interest rates are high. So bear in mind that when we're discussing this, it's under the circumstances that all other interest rates in other markets in the world are held constant. So which means ours here in this instance, where there's a contractionary monetary policy, has increased relative to other interest rates in other countries. So which means here, there's the interest rates are basically giving us a bigger return, right? Like I gave in the example of the bond market. So if you want to choose now between two markets and one is paying a bigger interest than the other, you obviously want to go for the market that's paying a bigger interest. So which is why our expectation now is that when the interest rates have increased, then there has to be an inflow of capital, right? There will have to be an inflow of capital because a lot of these guys now will want to invest, right, in that sort of market, right? So which means you're going to have an increase in the interest in the repo rate causing an increase in the interest rates, and then therefore this will gonna cause capital inflow, right? High capital inflow. All right. And then when that's the case now, when there is high capital inflow, this is because the prices of domestic stocks and securities. So what's the effects now? So there are two ways in which you can look at this, right? There are two ways in which you can look at this, of which we are going to further look into this again. I think it's in one of the following chapters when we're going to be dealing with interest rates in particular. There is a relationship between the interest rate and the price, right? There is that kind of relationship there between the interest rate and the price. So obviously, if there's going to be an inflow in the capital, it's because the prices of the domestic stocks have decreased, right? So this is also obviously part of the basic economics. So you're saying when the price is low, the demand is high, right? But then again, you will later realize the nexus between 2 and 4, right? These ones carry a negative relationship. Whenever the interest rates are high, the prices are going to be low. So these ones oppose each other. So you have an option there to look at that way. But we will deal with this again. But again, I must say this is also still part of second level macroeconomics. This is still macroeconomics. It's just the fancy word here that might throw you off, but it's still basically the same thing. So the way I'm breaking it down is basically just the way it is. All right. And then obviously, if there's going to be capital inflow, what's going to happen to the rand? So we are looking at this from our perspective in the rand. So whenever there's capital inflow, it means the rand is appreciating. How so? So this is also still under macroeconomic side. So because people that are demanding these domestic stocks and securities, why are they demanding them? Because the interest rates are high. And then we already said that when the interest rates are high, the prices of those domestic stocks are low, right? So when these foreigners are demanding these, or these external parties are demanding these domestic stocks, they need to bring in their foreign currency. So hence we are saying it's capital inflow. So this capital inflow is forex that is coming into the country. So when forex is coming into the country, in order for them to buy, right? In order for them to buy stuff that is in the country, they obviously need to convert their currencies into rands, right? So which means they are going to be purchasing more of the rands. So when they are purchasing more of the rands, they are demanding more of the rands. Hence, we expect the rand to appreciate. So this is all still logical, right? This is all still basic and logical. So another way to look at this again is whenever the interest rates move in the same direction as the exchange rate, right? So when the interest rates increase, the exchange rate also increases. So which is also an appreciation there, right? And then what happens now when there's an appreciation? So when there's an appreciation, it means the rand is stronger, right? It means that the rand has gained value. So what happens to foreign goods? So which means foreign goods are relatively less expensive now, because with your rands, you can purchase more now because your rand has got more value, right? So if your rand has got more value, then the other goods have become less expensive, right? So what's the effect now? What's the effect of this on net exports? So what is net exports? Net exports, you are basically looking at your exports minus your imports, right? So this is your net exports there. So because foreign goods are relatively less expensive, so in other words, they become cheaper, we expect that in real terms now, you are going to be importing more, right? We expect that we are gonna be importing more. So which means our net exports are therefore gonna decrease, right? Our net exports are gonna decrease. So in other words, our balance of payments should worsen under these circumstances. So this effect is basically going to induce us to import more than exporting. All right. So now what happens to all right, when now we are here on this one, on the net exports, we said the net exports are going to decrease. What's going to happen now to equity prices, right? What's going to happen to equity prices? So equities are also similar to, equities are also just the same as these are domestic stocks, right? Equities are also domestic stocks. So we expect these to move also in the same direction. So whenever people are investing, but then in fact, I need to just clarify one thing here before I forget, which is what we are going to be covering now. Equities are domestic stocks, yes. Equities are domestic stocks here and securities. But if we are going to be assessing this now in terms of interest rates, the option that you have would be either investing in your equities or investing in your bonds, right? Assuming that your bond is the one that is attached to the interest rate. So which means if you are going to be moving in favor of the bond in this instance, with these securities that are attached to the interest rates, then which means you are moving away from equities, right? So which means you are moving away from equities. So if you are moving away from equities, what's going to happen to the price of equities? This is what's going to happen to the price of equities again. We expect it to decrease. So it's just the same as above, right? Aggregate output, what we expect to happen to aggregate output, here we don't exactly know, right? Aggregate output is tied to the goods market, right? It's tied to the goods market. But here we are dealing with, we are specifically dealing with the financial market. So it's got no effect on our exports, right? So it's got no effect on our export, except to the extent that if our imports are going up, then we expect that. So with that logic that our imports are going up and our net exports are going up, then under those circumstances, the aggregate output would actually decrease, right? But which is also not a fair assumption there. We'll be holding quite a lot of things constant, right? And then the cost of imported goods and the price level will, right? What's going to happen now? So now we are saying, so the trick now with this one, again, is to come in and assess and see what did we say about these foreign goods. So we said the value of these foreign goods is going to be relatively less expensive. So when it's less expensive, then the cost of imported goods is therefore going to decrease, right? Together with the price level. So there's a kind of inflation, if you remember, that is triggered by cost, which is called the cost push inflation. So which is also triggered by if part of your inputs are imported. So once the prices of those go up, the price level is gonna follow suit and go up in there. So, but in this instance, we are saying because our currency is stronger, right? And when our currency is stronger, we are saying that the foreign goods have become less expensive because they've become less expensive. Sorry about that. I think I got slightly kicked out on this other mission. All right, so the trick now, I was still saying, we look at what's happening there on the foreign goods. So the foreign goods have become less expensive, and hence the cost of imported goods has decreased, and hence the price level has decreased. So as we are going to see much later, we are basically looking at the effects of a contractionary monetary policy through the exchange rate transmission mechanism. So when you engage in a contractionary monetary policy, excuse me, your main intention is usually to affect this here, the price level. You want to curb your inflation. So we are saying, how does this work through the exchange rate? This is basically what we're talking about. But again, we are going to be doing this over and over again until it's stuck in our heads. All right, so on today's work, we are looking at chapter 1, right? Our starting point, chapter 1. So we are going to be dealing with the financial markets. So on the prescribed textbook, this is going to be on your chapter 1 again. So these are summaries based on the prescribed textbook there. Right. So why study the financial markets? For starters, so financial markets are the markets in which funds are transferred from people who have an excess of available funds to people who have a shortage of funds. I don't know if you guys remember what we call these. If you remember what we used to call these. So it's basically people that have got an excess and then those that have got a deficit. Right? So it's a surplus and a deficit. So we are looking at those two economic participants there. So there are people that have got a lot of money that they are not using, right? So such people are the savers, people that are saving. So once you are leaving your money in the bank, you are basically a surplus unit, right? And then there are people like business owners who are always in search for these funds, who always want to take such loans. So we refer to those as those kind of economic participants that have got a shortage of funds, right? Where they are the deficit units, right? So the sort of things that you expect to find in the financial markets, of course, are the bonds and shares, etc. So which is what we are going to be looking at. So why is this important? Because it has a direct effect on personal wealth, right? The behavior of businesses and consumers. Also, again, we're looking at the cyclical performances of the economy. So the financial markets, I think if you recall, every time there is a crash in these financial markets, it basically affects every other thing within the market, right? Basically, it doesn't function properly. Some of the reasons why third world countries are not doing so well is probably because of their financial markets. This is the blood of the economy, right? So once it goes wrong here, it basically goes wrong everywhere, right? But in the financial markets, there are two things that you find in the financial market, right? I'm just going to mention this, but I think I didn't put it up here on the notes, right? You are either going to be looking at equity, right? Or you are going to be looking at debt, right? It's two kinds of things that you're going to be looking at in the financial market. So you can either be going to the equities market or you could be going to the debt market. So at the end of the day, remember, we are saying financial markets, we are saying it's where funds are transferred between these two economic participants. So you can either do that through equity or through debt, right? It's those two ways in which you could do that there. So when we are talking about equity now, equity, we are going to be dealing with common stock when we talk of equity. So it represents a share of ownership in a corporation. So if you're going to be buying equity in a company, you are basically buying ownership, right? The company, the kind of arrangement that you have with that company is not a debt arrangement where they are owing you something. No, you have bought stake in that company, so you are a part owner in that company. So it is a security that is a claim on the earnings and access to the corporation and access of the corporation to raise funds to finance its activities. Right. So what basically happens now? There are what we call, I think if you've done basic accounting, you will appreciate that. I think when they give you a definition of equity, right, they basically say, if I remember it well, it's the residual interest. It's the residual interest in the affairs of an organization or in the assets of an organization. So in other words, what you have there, what you have is your claim that you have there is the residual claim. So in other words, after all debt has been paid, what remains there belongs to the owners of the company. So if it's common stock, which is sometimes referred to as ordinary shares, you are the owners of that company, right? So you have that residual interest in that, or residual claim in that company, right? And then on the other side now, you are going to have debt, right? You are going to have debt on the other side. So in terms of debt now, there are two kinds of debts that we are going to be looking at here. Debt number one is our debts are classified as bonds, but we basically refer to them as bonds here. So it can either be a government bond or a corporate bond, right? Both of those are debt. So if you are a company, you have an option to go and if you want to raise funds as an organization, right? You could either do it through corporate bonds, right? Or work through, or if the government, sorry, I'm actually saying this the other way around. So if a company wants to raise funds, they basically issue corporate bonds, right? So in other words, they go to the public that have got excess funds, and they say, okay, here are bonds, corporate bonds. They could be Microsoft, MTN bonds. They give you those bonds, and then you are basically buying those bonds. So in buying those bonds, you are giving the company money, right? So you are basically the company is basically raising money through that means. So at the end of the day, funds are being transferred now from the public to the company through that vehicle of corporate bonds. And then in some instances now, the government may also want to raise funds. So the government is not a corporation, but the government is the government, right? So what they can basically do is to issue what we call government bonds, right? So the difference between these two now usually lies with the level of risk that is attached to each and every one of them, right? It basically lies with those. So with the government, the risk is very low. So when we talk of risk, there are two types of risks here, or basically two things that we're looking at here. Because if you're going to be dealing with a bond, we expect that there are going to be interest payments on that bond. It's a debt. It's like when you go to the bank and you get a loan, there's an interest that is attached to that. And then at the end of the day, again, you need to repay the capital amount, which is the amount that you initially borrowed from the bank, as it were, right? So, for instance, if you're going to be buying government bonds, the government is issuing new bonds. So at the end of the day, the government needs to pay you interest on that bond. And then at the end of that term, they need to pay you back the initial amount, right? As per the agreement, of course, the initial amount that has been agreed upon, which is the capital amount. So the risk now is in two ways. So risk number one is that the government or the corporations fail to pay the interests that are attached to that to the bond, right? And then risk number two is that the government could fail, or the corporation could fail to repay the capital amount, which is at the end of the period, right? So that's the risk. So which basically separates between the corporate bonds and the government bonds, because with the government bonds now, it's unlikely that they are going to default. So we are referring to the risk of default, basically, right? The government basically has the power through the Reserve Bank, right? Indirectly through the Reserve Bank to print money. So which means the risk that is attached to government bonds is very low, right? The risk of the government failing or defaulting in their payments is very, very low, right? That's the case with that. But with corporations do fail. Corporations are run by capitalists. Capitalists always seek to make money. So once they do get an opportunity to default, if it's in their favor, they obviously will default. But the government can't exactly do that, right? Government has got the option of printing money. Government also has the option of collecting taxes from people to pay back the amounts of the bond. So when we talk of interest rates now, there's a definition here, by the way, definition for you, which refers to the cost of borrowing. So when we talk of the interest rates, the government now, when we talk of the rate that is attached to the government bond, it's normally referred to as a risk-free rate, because there is really no risk that is attached to it. So whenever you hear of a risk-free rate, we are basically referring to the government bond rate. All right. So that's what you find there. That's basically the structure of the financial market. So on the financial markets, you find equities, and then you find debts on the other side. And then on the side of debts, we already said you are going to have corporate bonds, and then which is basically corporate debt, and then you're also going to have government debt on the other side. Right? So this is just for you to know the structure of this here. And then, of course, you might want to know the advantages, right? The advantages of equity over debt and the advantages of debt over equity. So that we are gonna look at, I think, in our next session. We're gonna start off there. But do ask, I think, some of your management accounting friends, or your friends who are doing management accounting, they should know this. And maybe your friends who are doing accounting, they should know this, but we are going to tackle it again briefly in passing. Right, and then chapter 2 now deals with the functions of these financial markets. What are the functions? So we've got all that listed there. So they perform essential economic functions of channeling. We already said this, channeling funds from households and the governments that have saved surplus funds by spending less than their income to those that have a shortage of funds, right? So there's a lot that we are going to talk about with regards to this much later, something that is more practical, something that is more relatable, right? I know we are adults here, so most of you guys are maybe investing or at least saving. So we are gonna be talking about this as we go further, but it's not examining, right? It's just out of curiosity. All right, so this is again this is attached to that. So they basically allow funds to move from people that who lack productive investment opportunities to those who have such opportunities, right? So this is what you are going to be going through there. But I would love to look at this on the questions that follow, right? So the structure now, we've already looked at these two, right? We've already looked at these two prior when I was explaining. That's there. And then again, the other distinction that comes into play here is the primary markets and the secondary market. So this is also very important. So when an organization or when the government seeks to raise money, they want to seek to raise funds, they want to go to the primary markets, right? Why the primary market? Because this is where a new issue of a security is sold, or this is where it occurs. So whenever, say, Vodacom, whenever they've got a new investment that they want to pursue, and then they seek to raise funds from that, they have the option of going to the primary market, because that money directly goes to the issuer, right? But let's say now you bought yourself a government bond. You see, you bought yourself a government bond. Maybe say you were 22 years old and you had a lot of money. So you decided you had excess money. You decided that you were going to buy bonds. So you bought a government bond. What if you don't want that bond anymore? It's good because there is a secondary market. So this is where such securities that have initially been sold there, traded on the primary markets, can be resold here, right? Can be resold here on the secondary market. So this one here is between economic participants. It's got nothing to do with the original issue. So in other words, it could be between me and you, right? Selling each other stock from MTN and selling each other stock from Vodacom, right? It's got nothing to do with Vodacom, right? So all that occurs there in the secondary market. So a lot of transactions occur here, right, as compared to the primary market. So all these traders trade on the secondary market, right? Most of them, they are trading on the secondary market, right? And then of course, we will have this, I'm gonna leave you to go through. You will have the exchange markets, right? So these are also very important in the well functioning of the economy, right? So you are basically looking at ours here is the Johannesburg Stock Exchange, right? But there is the London Stock Exchange, the New York Stock Exchange, etc. So this is where foreign currency is traded. So foreign currency is also a commodity. So we're talking about, I think, the value of foreign currency going up and down on that previous question there. So sometimes the reason why it's going up and down is what's happening. Is what's happening on the exchange markets. The demand and the supply that's going on there, right? And then you have over-the-counter market. So this is a market in which dealers at different locations who have inventory of securities stand ready to buy and sell securities over the counter to anyone who comes to them and is willing to access their prices. And then of course we'll have the money market. So money markets we are gonna be dealing with again much later. So it refers to financial markets, which is on the short term, right? And then capital markets, we are gonna be dealing with this on the longer term, right? So this is basically still talking about the structure of this, right? So remember, we started off there with the basic structure, which we're discussing, where you've got debt and equities, right? And then we said, when you are trading debt and equity, it could happen either on the primary markets or on the secondary markets, okay? But a lot of other things are involved, right? A lot of other things are involved. We saw in the previous example there that the repo rate went up, and then all of a sudden we're saying there was capital inflow. Capital inflow goes through the exchange markets, right? So it's still part of the financial system, right? What are you buying? You're most likely going to be buying over the counter markets, right? Again, either in the money markets or in the capital markets, right? And then there are some of these instruments that you will come across again. You will keep coming across over and over again. So here, you simply need to read through these definitions there and see what they are. So the treasury bills, these are very common. These are short term. So if it's short term, normally it's going to be within a year, right? This is normally going to be within a year, right? These treasury bills. So treasury bills are more like bonds, right? These are more like bonds, but these bonds are redeemable within that short period of time, right? And then of course you would have these CDs here, right? Which is bank certificates of deposit. So a debt instrument sold by the bank to a depositor or the depositors that pay annual interest of given amount at maturity, and then at maturity it pays back the original amount. So it also works pretty much the same way as a bond, except that it's issued and it's called a certificate of deposit. So you will realize that these basically work the same way. There are people who work in these financial markets whose job is to design and be innovative when it comes to these securities, right? Creating different securities, because you find that one security can be suitable for one person but not suitable for the other person, you see. So hence you find treasury bills, CDs, commercial papers, repurchase agreements. So all of these, you are basically borrowing money, right? But the T's and C's is what basically differentiates between all these, all right? So the repurchase agreement, so this one usually occurs between banks. In our context, we'll be talking about this between the Reserve Bank and other banks, right? So hence we talk about the repo rate. So this is where it's coming from. So it's because the South African Reserve Bank would have gone into repurchase agreements with other banks, right? So what are those in any case? So they're effectively short-term loans, usually with a maturity of less than 2 weeks, for which treasury bills serve as collateral, right? An asset that the lender receives if the borrower does not pay back the loan. So what's basically happening here is the financial system or the banking system is very complex, by the way. But what basically happens is the Reserve Bank basically forces through legislation, through regulation, basically forces these banks to go into liquidity crisis. And then, as you know, from your second level, that the South African Reserve Bank is the lender of last resort, right? So when banks can't borrow from each other, they resort to getting a bailout in terms of a loan, getting a loan from the Reserve Bank. But that loan now comes in the form of a repurchase agreement, right? It basically comes in the form of a repurchase agreement. So where now we are saying these securities are sold. So what basically happens now is the banks do not have money. The banks need money, right? And then the South African Reserve Bank has money, right? So they basically trade these loans, right? So they say maybe the loan is gonna be worth 2,000 rands, but when it's paid back, it's gonna be 2,500. So the difference there between 2,000 to 2,500 is the repurchase. It's as a result of this repurchase agreement, which is where the repo rate comes from. So that 500 gives us the rate, which is the repo rate. So which is the rate with which these banks and the Reserve Bank can transact in these short-term loans. Right. So this is the rate that presumably affects every other rate in the market. Right. So that's what happens. So they basically sell you a security, and because it is a repurchase agreement, they need to repurchase that security again from you, but at a higher price. That's what basically happens. Then again, treasury bills serve as collateral for this. So they are indirectly forcing these banks to have treasury bills. So these treasury bills, we already said these are bonds, right? These are bonds, short-term bonds. So these are gonna serve as collateral. So this is in a way now forcing these banks to have treasury bills, right? It's in a way forcing them to have those. All right, then the other thing that you find now within the financial markets are financial intermediaries, which are very important, by the way. Financial intermediaries. So why is that the case? So it's the case because there are two issues: direct financing and indirect financing. So direct financing refers to a situation where you can borrow funds directly from a saving, right? So which is usually not the case. But if you are black and you've been to a township, you know that there are these people that we call loan sharks, right? So you go directly to those. So that's an example of direct financing, right? When your aunt is borrowing you money, that's direct financing. But then for the most part, most of the transactions are going to be occurring through indirect financing. So of which it's going through financial intermediaries. So examples of financial intermediaries would be banks, insurance companies, and the likes. So they are basically going in between you and the savers, right? So in other words, they are in between those. All right. And then one problem that could arise now in these financial markets is the problem of asymmetry of information. Right. So this is very important. You will get a lot of questions on this. Right. So asymmetry information basically means, or is a situation where one party knows more about the transaction than the other party. So in other words, if you're looking at two economic participants, let's look at let's say Microsoft, they want to issue corporate bonds, right? And then we are saying, in order for you to buy those corporate bonds, you need some sort of guarantee, right? You need some sort of guarantee because you're about to enter into a long-term contract or a long-term agreement with Microsoft, right? So that long-term agreement is that you are going to give them money in exchange for a paper, right? Which is a security, which is gonna be representative of your investment in those corporate bonds. And then their part of the agreement, their part of the deal is that they are gonna be paying you back interest at certain intervals, and then they are gonna repay you the capital amount, say after X amount of years, right? So what if Microsoft knows that they are going to close down in 3 years, but they've already entered into a contract they've already entered or bound themselves to a 10-year contract with you. So asymmetric information basically tells us of that kind of situation where the principals or the managers of Microsoft have got more information about Microsoft than you, the investor on the outside. You see, so that is asymmetric information. So that basically creates problems with the financial systems because at the end of the day, you do not want to transact because you are afraid it's risky now, right? Look at what happened to, I think it was VPS Bank not so long ago. So had you been an investor in VPS Bank, you're gonna lose out, right? You're obviously gonna lose out. Say you bought shares 6 months before the company went down, you're gonna go down with the company, right? So at the end of the day, it's a bit tricky in reality because you can't exactly trade with information. They call that insider trading, by the way. Say you know that the bank is gonna close down, that bank is gonna close down, or the value of those shares is gonna go down. So if you take that information from the inside of the organization and use it to execute your trade, to buy or sell a share, and then it's insider trading, it's not legal, right? It's not legal. But at the end of the day, there's always gonna be a situation of asymmetry of information, right? So we wanna clean that as much as possible for our financial markets to function, right? So asymmetric information, this problem comes in two ways. Number one, adverse selection, and then number two, it's moral hazard. So adverse selection, this one occurs before the transaction, right? This one occurs before the transaction. So it's a problem created by asymmetric information before the transaction occurs. So an example there is when a potential borrower, right, who is more likely to produce undesirable outcomes. So in other words, is a bad credit risk. They are the ones who are actively seeking out loans, right? So in other words, before the transaction ever occurs, if someone is coming to you and then they need you to lend them some money, it's a likelihood that they are probably a wasteful person, right? They are probably a wasteful person. So the kind of people, when we talk of adverse selection, we are saying the kind of people now that are attracted to that debt market are the people that are likely to produce undesirable outcomes. The fact that it's likely that the fact that someone is going to look for a loan, right? It's likely that it's because he has failed to manage certain affairs within within either the organization or personal life. So adverse selection occurs before the transaction, right? In terms of what kind of clients are coming, right? And then moral hazard, now that they've come, the moral hazard is what kind of activities are they engaging in? So they might engage in activities that are undesirable or immoral from the lender's point of view. So that you've borrowed someone's money doesn't mean you should waste that money. So now that they've borrowed that money, moral hazard is that they're now engaging in maybe fruitless exercises. If it's an organization, you could have borrowed money and then you take that money now and then you engage in in projects that are not worthwhile, right? All right, so possible examination questions that we could come across. Briefly explain in general terms what is the meaning of a security and how does it facilitate direct lending. So I think up there's a definition of security, but in the general financial context, security refers to a financial instrument that represents ownership, debt, or a claim on a specific asset or a stream of income, stream of cash flows. Right, so securities are typically tradable and represent a way for individuals, companies and governments to raise capital and manage risk in the financial markets. So we already spoke about that. But when it comes to facilitating direct lending and borrowing, securities play a crucial role, right? What kind of role is that? Number one, borrowing of funds through the issuance. So this is the major one, which is put there on number two. So obviously, if you are going to be issuing securities, you need money, right? You are trying to borrow money. It's a smart way of borrowing money, right? We are basically issuing those securities. So it's like Microsoft issuing those corporate bonds. So they are basically borrowing money from you when you are buying those corporate bonds. And then it can be used again as a collateral. So remember when we were talking about those repurchase agreements, we said those bonds, right, of which we say the type of bonds they are the treasury bills. Treasury bills are used as collateral there. So a treasury bill is a security, right? Then of course, liquidity and marketability. So securities are often traded on the financial market. So you are gonna get them being traded mostly where on the secondary market, right? They are gonna be traded on the secondary market. So whenever you need money, that's what you could do. And then diversification and risk management. So securities offer investments the ability to diversify their investments and manage their risk. So obviously investors choose from a wide range of securities with varying risks and return profiles. So you obviously don't buy the same kind of security, right? Unless if that's like seriously gambling, right? And then price discovery again. So it basically helps us in the pricing mechanism there. Intermediation, financial intermediaries such as banks, investment funds, and brokerage firms often facilitate lending and borrowing transactions involving securities. So these intermediaries connect borrowers and lenders, provide expertise, and help meet the needs of both of these parties. So remember now, I was talking about how there's a group of people that actually design these securities to meet specific needs, right, for different parties. So lenders have got specific needs on the one side, borrowers have got specific needs on the other side. So these financial intermediaries now use these securities or invent securities that can best cater for those needs, right? And then list and define 3 commonly used measures of aggregate price levels. So on the question there, on the previous question, we're talking about price levels, right? So how do you measure price level? You want to measure inflation, right? That's basically what you're doing there. But the correct thing to say is you're measuring your price level because it could go up or it could go down. So you've got your CPI, Consumer Price Index. So that one I think you know quite a lot of, right? You could have done that before. You've seen quite a lot of that, right? So CPI is used to gauge inflation and is often referred to as a measure of the cost of living. So what CPI basically does, looks at the prices from the perspective of the consumer. What are you consuming? What sort of goods are you consuming there? So they basically have a basket, right? They basically have a basket and say the average household is going to be consuming A, B, C, and D. So how have the prices of those commodities changed, right? So in terms of your consumption, right? Then on the other side, we can also measure the aggregate price level through producer price index. So unlike the CPI, this one focuses on the production, the changes at the producer or wholesale levels, right? That's the difference there. But obviously, because we spoke about cost push inflation, it will obviously originate from production there, right? And then again, you will have the GDP deflator, right? So what's the GDP deflator? So it basically adjusts your nominal GDP to arrive at your real GDP. So we call that the GDP deflator. So nominal GDP is your GDP at current prices, but we want it at basic prices. So how do you go about that? We use the GDP deflator there. But at least ways in which the quantity of money may affect the economy. So this we are going to do much later when we're dealing with money, but go through it again as part of your notes there. Explain the functions performed by the financial intermediaries and how and why these promote economic efficiency. So financial intermediaries play a crucial role in the functioning of financial markets by facilitating the flow of funds between savers and borrowers. So they perform several important functions that contribute to the efficiency of financial markets and the overall economy. So what are those? Pooling of resources together, right? Think about Old Mutual here, right? Think about Old Mutual. So financial intermediaries gather funds from multiple savers and pool them together. So here they are basically getting money from a lot of people, even banks, right? Banks basically have got access to money from a lot of savers, right? So this is what we talk about pooling resources. So they are not just talking about I've got 1,000 rands in the bank now, but think about this. There are 50 more people that have got that 1,000 rands. So that's going to make it 50,000. So this is pooling resources together. So when a businessman goes to the bank and they want a loan, they can get 50,000. Risk transformation. So they help transform risk preferences of savers and borrowers, right? So they are bridging the gap between those two. We already spoke about that today. So this is obviously through sometimes inventing these securities that can cater for those, right? Information asymmetry, go to the bank and get advice, right? They will give you a lot of information. Sometimes there are websites that also give you information about companies before you invest in those companies, right? So that's what happens there. And then transaction cost reduction. It's very difficult to buy shares from a company if you're not going to be buying through a broker, right? So a broker will basically reduce those overall transaction costs for you, right? And better yet, it's better to buy with your little money. It's better to buy through Old Mutual, right? Liquidity provision, of course, that's what they do, right? And then maturity transformation. So here, financial intermediaries engage in maturity transformation where they borrow funds from savers with shorter investment horizons and lend to those with longer term needs. So this helps align, right? This basically helps align the preferences of savers and borrowers to promote efficient allocation of funds. Specialized expertise, obviously, right? If you want good financial advice, go to the banks, go to these financial intermediaries. They will ideally give you expert advice. Diversification, what Old Mutual does, right? So instead of you buying shares from one company, what Old Mutual does, it's gonna take 1,000 or 10,000 from a lot of people. And then in the end, they've got a lot of money, and then they can diversify, right? They can basically diversify. So by diversification, we are saying they are basically buying from different portfolios, right? Markets that have got buying stocks that have got different sectors, right? And then when that happens, they are basically diversifying. So when one falls, it's likely that the other one could be rising. All right, so please go through the notes that are provided here. Then if you have any questions, please just refer the questions in the group. And then please let me know about assignment 1. I can't remember what we said about assignment 1. Please let me know if assignment 1 is already open so that we can also start making means to tackle that.